This is it. So every new day you are presented with what? A fresh start. I am a new trader. I am a total beginner. Where do I start from? Is that okay? Like, what do I do when I'm given this? It could be a chart of pounds USD. It can be a chart of gold. Right? It can be a chart of index, that's US 30. So whatever the chart you are presented with, whether it's crypto, whether it's stocks, whether it's forex, it is the same concept, right? So first you ask yourself, so reset your screen and reset your chart so that you have data. You see from here to this end, from this side to this side, this is the data we are presented with. Work with that data. You have enough data. Is that okay? So if you are using a laptop, an iPad, a tablet, or a phone, whatever data you are given, work with it. Is that okay? So now, oh, I'm new. I don't know how to trade, but I really want to know how to go about this thing. So the first thing you ask yourself, which one is the low point on your screen that price has been? So looking from this place to this place, which one is the lowest point price has been? Perfect. And so you spot your low point and then you take a horizontal line. Okay. A horizontal line. Then you put it there, the lowest point. This is the lowest point price has been. Is that okay? You see now we have a value showing 1.31. When we didn't have the horizontal, we didn't know. We're like, oh, just this area. But now we have a specific number or a specific price point. Is that okay? Now the next thing. So now the lowest point becomes what your support. That means that when price came to this level, price had a level of support, a place to hold it. Is that okay? If it didn't have a place to hold it, it will just keep dropping, keep falling. Is that okay? So now the same way you ask yourself, this data I'm given, which one is the highest point price has been to? Yes. Perfect. So this is what the highest point. Then you take what? A horizontal line and then you mark that level. So you see that now we have this level and that level to work with. Is that okay? Now ask yourself, from this high and this low, which one is the middle level? So this one is eyeballing it. So I can measure, okay, which side would you pick as a middle? Yeah. Perfect. Right here. So you take what? Horizontal line. Here, right? Yeah. Yes. Perfect. Then you drop it. So what have you done? What you did is what? You have spotted your support. That's the lowest level. 1.31640. You have spotted your resistance. That's the highest level. 1.39811. And you have spotted what? Your mid-level or your 50% level. That is what? 1.35485. Is that okay? So 50% level, we normally get it with a Fibonacci. So it's a drawing tool. It's like a ruler that measures like certain repeated values. Is that okay? So you pick it from 0 to 100 and then it plots certain values like 0.50 level, 0.32 level, 0.68 level. So there are different levels. Is that okay? So we'll get to that. So that's the first things first. Mark your support, mark your resistance, mark your mid-level. And why are we marking this? We are marking this so that we'll know where price is likely to head to or come to. Is that okay? Realize that if you are going somewhere, you don't just stand in front of your house and you get a car. You have to go to the bus stop to get a car. So in the same way, if you want to take a trade, you have to wait for price to come to that area, that premium area. Is that okay? So more like the analogy, a bus stop to take the trade. You don't just open your chart and click buy, sell just because you have money in your account. Are you getting it? So in the same way, when you mark this point, you know that, okay, now this is like a bus stop where buses come to load people. Okay, there's another bus stop where buses come to load people. So in the same way, when price come here, then we are looking at entering trades. When price comes here, we are looking at entering trade. And when price comes here, we are looking at taking profits. Is that okay? So if price is this low and you take a buy, you're looking at taking your profit when it comes to the middle. If price is this high and you take a sell, you're looking at taking profit when it comes to this level. Is that okay? So you have what? Support, resistance, mid-level. And this can be repeated on every time frame. You are currently on the daily time frame. You can go to 4 hours, repeat it. 1 hour, repeat it. 15 minutes, 5 minutes. Is that okay? I don't suggest trading the 1 minute. It's too noisy. Are you getting it? So anywhere from 5 minutes and up, you get a nice play of price action. Is that okay? So now, so the first step is what? Mark your levels. And what is that level? The support, the resistance, and the mid-level. Now, the second step, mark your zones. Is that okay? Now, what is the zone? The demand zone, the supply zone, and the golden zone. So you see, what we are doing when you're trading is you're buying and selling. It's business. So if you wanted to buy something, don't you prefer to buy it at a discount price? Are you getting it? Oh, this thing is $1,000. Now, okay, we have a discount, so it's $700. Don't you prefer to buy it at 700 instead of 1,000? So that is why we wait. We don't buy anywhere or sell anywhere. We wait for levels, premium levels. Is that okay? Wait for price to come to a certain area. Then see that the main concept is of buy low and sell high. So if price is high, you're not looking at getting involved in the buy. All you're looking for is getting involved in a sell. So you wait for a sell setup to show up, then you take a sell. When price is low, you're not looking at getting involved in the sell. You are looking at getting involved in a buy. So you wait for a buy setup to show up, and then you take a trade. Is that okay? So now these zones you are going to mark is the demand and the supply, right? So when you come to this low point, you ask yourself, you see we have red and green candles. Red stands for bearish market. Market is selling off. Green stands for bullish market. Market is buying up. So before this buying, you see that it has been buying, going up from this low level, it start rising. So you ask yourself, which one is the last red candle that showed that before buyers took over the market to push the market up? So the trade is between buyers and sellers. So at one time, buyers will take over. At another time, sellers will take over. Is that okay? So now you're asking, what was that moment buyers took over the market from sellers? And what was that particular moment that sellers also took over the market from buyers? Is that okay? So when you look here at this low point, which red candle will you say, oh, this one is actually the last red candle before buyers took over? So show me. FX. Is that okay? So you see that after this red candle, buyers took over the market, going up. So what do? You mark that zone. You create a zone around it from the high of that red candle to the low of that red candle. Is that okay? Or you let it touch the resistance you've drawn. Is that okay? And then we can extend it to the left and extend it to the right to cover the whole zone. So what do? We take what? We take a rectangle, right? Then what do we do? From the top to the bottom, right? And then we look at taking buy trades below here. This is why we look at taking buy trades. Is that okay? Buy low.
Anytime it's low, you take buy. Anytime it's high, you take sell.
Yes. So anytime it's high, you look for. It's like you don't immediately. You are looking for. When it's low, you are looking for a buy opportunity. Sometimes it might be low, but the buy opportunity will not be ready. So you don't get involved in the market. Wait for it to be ready. It can be staying in the low area, but there's a particular point. There are certain triggers that show that now it's time for you to get involved in the market. Now it's time for you to buy the market. Now it's time for you to sell the market. Is that okay? And so let's extend it to the left as well. It covers. So you see, we've covered the zone. So you see, price is currently here, 1.33869. So we are hoping that price will drop and come into the zone. When it comes into the zone, what opportunity are we looking for?
Buy.
Exactly. We look for a buy opportunity. Is that okay? And then when we come to the resistance, same way, ask yourself, which one is the last green candle before sellers took over the market from the buyers?
Last green. This one.
So that is correct, right? When you look here, you say that this is the last what? Green candle before what? Sellers took over. So you draw what? A zone around it. So from the tip, okay, I'll make it sell red. We look for sell opportunities here. Is that okay? Now, if you look higher in this area, which is the last green candle before sellers took over?
First one is to
Perfect. So this is the last green candle before sellers took the market. So you draw a zone around it. Are you getting it? So what that means is you are looking at taking cells in this zone. You're looking at taking cells in this zone. Is that okay? The same way you're looking at taking buys in this zone. So this can be repeated on any time frame. So when you sit down and say, okay, I'm going to trade a 15 minutes time frame, repeat this process on the 15 minutes time frame. So that as I'm going to trade a 1 hour time frame, repeat this process on the 1 hour time. Because trading, there are different kinds of trading. We have a swing trader. He's only interested in taking trades for long term. He might enter a trade on Monday and he's interested in closing that trade on Wednesday. He doesn't check the chart again once he takes his trade. He has his stop loss and his take profit in. Is that okay? There's also a scalper who is in and out. He doesn't stay in the trade for more than 30 minutes. He enters, he's looking for a quick move. He closes profit, looks for another opportunity. Are you getting it? There are other day traders. It's like, hey, I take this trade today. I might look at the trade at the end of the week or 2 weeks. So like they are long-term traders. So you find yourself, find your drive, find like, okay, I'm more interested in scalping. I'm more interested in swinging based on how trading fits into your lifestyle. You know, okay, I work 9 to 5 and I'm busy. I just have 30 minutes in the morning. So I'll use that morning to set up my chart, maybe on the 1 hour time frame. Maybe I might come back and check 4 hourly on a 4 hour basis. I get so based on your lifestyle and how you are fitting it inside, you go with it. Is that okay? So this is the second step, marking your zones. Like so now I'll keep the zones, the demand zone, the supply zone, and the golden zone. So I'm going to take this one out. I just want it to be three, right? But you selected it correctly. If you look at the drop down, this drop down, which one is the last? This is the last thing before the drop happens. Okay. So now so then what that means is that if at any point price returns here, then you'll be looking for a sell opportunity here. Is that okay? So now when you do your demand and your supply, working with the support and the resistance you started with, is that okay? See, we started with the support here, resistance here. So we are looking for the zones around those areas. Is that okay? If that's not the case, we can get multiple zones. We can get this as the last one before the drop. We can draw a zone around here. Then when you come here, around this area, I can get that this is the last green before the drop. So you can get another zone here. When we come here, this was the last green before the drop. You can get another zone. So you can get like multiple zones. Is that okay? And these zones become other block. So this one will be other block 1, other block 2, other block 3. Is that okay? So all these things work. We are keeping it to the demand and the supply, right? And then the next one is what? Your golden zone. So how do you draw a golden zone? You pull out the Fibonacci tool. It's a drawing tool that gives various gradation as the market goes, right? The points are certain levels that price is likely to retrace from, or have a reversal from, or have some massive reaction from, or get some interest from traders. And one of those interests is the golden zone. When price gets to the 0.5 level on the Fibonacci, or the 0.68 level on the Fibonacci, traders like to counteract the market move. Is that okay? And traders also like to take their profits at that area. So in that zone, I always call it a no man's zone. At that zone, price can decide to be bullish or price can decide to be bearish. Whoever is stronger at that point takes over the market. Is that okay? But when it comes to demand and supply, when price is at a demand level, there's a higher probability of looking for buy opportunities. And when price is at a supply level, there's a higher probability of looking for sell opportunities. But when you come to the golden zone, then the probability is now 50-50. Is that okay? 50 time buyers can take over, 50% time sellers can take over. But at this demand and supply, the proportion or the ratio, the probability goes high. Okay, so at demand, higher probability for buy opportunities, and at supply, higher probability for sell opportunities. So now to draw our demand zone, we put a Fibonacci. The two is a Fibonacci retracement. So when you select it, see market move from this top and drop to this low. So you start from the top, drop it here, then you extend it to what? The low. Is that okay? Then you drop it. Now, do you see the levels of the Fibonacci? Start from 0 to 100, right? 0 to 100 or 1. Then 0.5, that's the 50% level. Is that okay? And have 0.38 level, 0.61 level, right? So you see that this level, when we're drawing the mid-level, we use our eyeball to just eyeball it. When you pull the Fibonacci, it tells you the exact zone it's supposed to be. So it's supposed to be at the 0.5. So you can simply what? Adjust this and put it there. Are you getting it? Now what is that golden zone? So the golden zone is what? That 50% level. A little portion above it and a little portion below it. And capture that zone as your golden zone. Is that okay? So we'll take a rectangle. And then at the middle, go like, okay, half portion here. And then another half portion here below. Right. Then the golden, I like to use the color yellow. So now we are done with what the Fibonacci. You can take it off. Is that okay? So you see that the market drops. When the market was dropping, the drop came close to. So the first time the market dropped, right? It dropped and it came to this 50 area, this golden zone. Then there was a reaction, pushing market back up. Then it came there again. And then there was a reaction. This time what? Bringing price down. So I told you that what? It's a no man's zone. When it gets there, buyers can decide to take over. Sellers can, whoever is stronger, they control the market. Okay. So we use that to get our golden zone. Then we can take the Fibonacci off. So you see from a clean or a raw sheet, or a raw chart, now you see we are developing it. It's like an act. You are the creator of the act. Like, play around it with understanding. It's not like, oh, I'm buying or selling, but you have what? You have rules, you have systems that you're looking at. So the green is what? Ready to buy. Red, ready to sell. Golden, take profit. No man's zone. You can buy or can sell. You can do whatever I want. So price got here, and then buyers decided to push it up, then sell it. So that's whatever it likes in the golden zone. But you are looking at what? Entering or getting involved in the market at this area, pull it up, or at this area, pull it down. I get it. So if you realize, if you follow the system repeatedly, all you have to do is wait for the setup. When it's ready, join the move. Is that okay? And then this is not tied to only one time frame. It's not only to 4 hour time frame. It's not only to 1 hour time frame. You can go to 5 minutes. same raw chart, repeat the process. Is that okay? So now we are on pounds USD, but let's go to euro. Let's go to pounds JPY, right? And then we're on the daily, but this time around, we are going to the 1 hour time frame. Okay. So with the data you have, repeat the process. Lowest level on our chart is here, right? Highest level on our chart is here, right? Mid level on our chart is here. You just eyeball it and put it here. Now, ask yourself, last red candle before buyers took over. This is the last red candle. So, draw a rectangle. Is that okay? And then you make the color green because you look at buying here. Then again, last green candle before sellers took over, right? This is the last green candle. Take a rectangle. And the color red. Looking to sell. Then we come our golden zone. We pull out the Fibonacci. We pick it from the swing high to the swing low. Now, okay, it came from this high, dropped to this low. So we pick it, Fibonacci. Okay. Then go like, okay, this is the 50% level, right? So I pick my a little level above and a little level below. Then I make the color yellow. Then okay, the use of my Fibonacci, I got my golden zone. That thing we did on the daily, we've done it on the 1 hour. If you decide to go 15 minutes, the same thing, same process every day. You decide as a trader, what kind of trader am I? Is that okay? So I don't like stress. Okay, I would like to stick with a 4 hour time frame. It's slow. It takes time, but I'm okay with that. It takes away the stress. Oh, Charlie, my Vim day, I'll stay on the 5 minutes. Like I can handle it. I'm in and out. Like the blood is running. The temperature is like, yes, I can do this. I have all day to myself. I can sit on the chat, behind the chat, and repeat it. Is that okay? So it's a repeated process, a systematic process. So when you look at the checklist, I don't know if I've sent it to you, to the Bediak Trading Academy, our checklist, what we look out for before taking a trade. It's outlined. Step 1, we look for the step 2. So every time it's a repeated process. Because if you are trading without a system, I honestly don't know what you're doing. To me, it's like you're gambling. Like, what data can you show for what you're doing? Can you explain to me why? I'm not interested in the fact that, okay, this trade was a win, but what led to you calling out this trade and getting that win? That's the most important thing. Because that is, if you're able to spot it out, then you know that you can repeat it every day, every day, every day. And it's for systematic. It is mechanical. It is rule-based. And then you are repeating it every day. So let's go back to the pounds USD, and then you go to the day. You see that when it came to the 1 hour, the zone has become very big. But on the daily, it's like it's small. Right? Because on the daily, we are dealing with information or data from like July till now. But when you go to the 1 hour, you are dealing with like data for like 5 days. But now you're dealing like 6 months. Are you getting so the difference? So when you find yourself like long-term trader, then you want to stay on the higher time frames. Like I get paid at the beginning of the month. That's when I want to get involved in the trade. I take the trade. I'll come back next pay day. Then are you getting it? So you find yourself and see, oh, per my lifestyle, if I trade this kind of way, I'll be more convenient and very relaxed with my trading. Are we okay? I follow. Yes, I follow. You have any question?
For instance, when you're selling here, your stop loss or comes here.
So when you are selling here, right? So That is when you're selling means you are going short. So let's do an example. Short, right? You're selling here. So it means you are getting involved in the market at 1.3900. That is where when price gets there, I'm selling, right? Then I say that when I sell and price, it means that why am I selling? I'm selling because I have a speculation that price will come down. But should in case price decide to go above this level, this zone, so it comes to this level, stop me out. It means my analysis or my speculation of the market didn't play out. I'm not going to stay in the market forever. Are you getting it? So, and this whole zone is a selling zone. So trader A might decide to get involved at this point, 1.389. Trader B might decide to get the trader 1.3939, like the middle. Trader C might decide to get it at the extreme top. But we are all in the zone. How you get in? So you decide when to get in the trade. And then when you get in, your stop loss should be above it.
Above it. Okay.
Exactly. So now since you are taking a short, we say that, okay, if price comes to this level, right? Price, let's say price moves and comes up, rises up to this level, then we are looking at, okay, we want to short the market. So that is what we are expecting that the market will sell. And see that the stop loss is up here and it's too big, but we'll adjust it. Just bring it a little here, a little above our zone. Is that okay? And then you aim for what? 2 times of what your stop loss is. So whatever I stop loss, right now I'm aiming for 1.59. So always want a 1:2. Whatever we are risking, at least we should get. So we have the 2 point something. So we have what? Whatever we are risking. If you are risking 100, then you are risking 100 to make 200. And then you're okay. So you don't take a trade and you're panicking. Why? Because it is calculated. You've calculated a risk. Hey, this trade, I'm entering it at 50. I'll lose $50. If I win, I make $100, and I'm okay with that. You have it predefined. And so when it happens, you don't shake. Is that okay? And when the trade gets activated, you are not panicking. You're not sitting behind your screen watching for it to go to take profit, change now. No. Then it's like you start to panic when you start to over leverage. You start to over risk more than what your account can hold. Is that okay? Maybe your account, you should be risking 5% of the account size. Now you are there risking 50%. All of a sudden, you want your $1,000 to produce 500 extra dollars in one trade. Then you should be afraid. You should be scared because the market can turn and go against you right now. Is that okay? So let me.
The tension on the shoulders.
Is that okay? You realize that when you're trading, three basic things. I'm like, I tell new traders is this: you need discipline. What's that discipline? I have a system I'm trading with. Am I disciplined enough for the setup to show up before I take the trade? So you need patience. It takes time for price to come there. So if you are trading on the daily time frame, it might take about 20 days before this move happens. Is that okay? Maybe if you're on the 5 minutes, it might take 2 hours before it happens. Maybe if you're on the 1 hour, it might take 6 to 10 hours before it happens. So patience is a virtue you must have. Discipline, patience, and proper risk management. You are risking your account well. Like whatever account size you are using, you can divide it into 20 parts. So every trade you are trading, you are using that one part of that trade. Don't try and blow half of your account in just one trade. Don't do that. Don't even try and blow like 10% in one trade, like proper risk it. Or I've divided into 20 parts. If the first part doesn't go in my favor, I have 19 more parts to trade. Is that okay? So there are 19 unique opportunities that will show up again for me to trade. And so when you're able to understand trading in terms of percentage, in terms of like, oh, rationing, I'm taking just a portion to make this, to make twice or 3 times of that, then you'll be okay. Your trading will change, your psychology will change. Is that okay? So basically the same. So if you are decided to buy, right, trader A can decide to buy here, 1.32434. Trader B can decide to buy here, 1.32024. Trader C can decide to buy here. Are you getting it? And then we know that what our stop loss will go a little below what the swing. So this is a swing high. So if you are taking a sell, it should go a little above the swing. If you are taking the buy, then this is the swing low. So it should go below, a little below the swing low. Is that okay? So let's take a long position. So long means what you are buying and you're expecting to get involved in the market if it comes to this area. So you see that the stop loss is below. So we adjust it a little. You see that was way too big. Now you adjust it. Then you're aiming for what? 1:2. Now you have 1:1.5. So it means that if you are risking 100, then you'll be making 150, right? But I want to do 1:2. If you are risking 100, then I want to make 200. So this is how your trade will be looking at. Is that okay? And this can be repeated on any time frame. All you have to do is know the system, know the strategy, know the process, and follow it. Are you getting it? So good. So step 1, mark your levels, support, resistance, mid-level, or the 50% level. Step 2, mark your zones, your demand, your supply, your golden zone. Is that okay? Now the third process is, it's a third confluence, is waiting. What are you waiting for? You are waiting for price to come to your zone. You realize you have zones, then why did you mark your zone? It's because those are the points. We call it the point of interest or the area of interest. These are the areas you are interested in getting into a trade. You are interested in taking a trade. Is that okay? You are simply waiting. Here, currently price is not in the zone, is it? Here, currently price is not in the zone, is it? So what do? You are waiting. That is the third confluence. Yo, Glenn. Yeah, I do. Yeah, yeah. Okay. So you get it. So what are you doing? The third process and the hardest process is the waiting process. Because we have money in our account, we can't wait to take a trade. It's like we are itching to buy or sell. But if you don't wait, you end up gambling. You end up taking a buy, taking a sell because I feel like it's buying. I feel like it's selling. No, it's a system. Follow the system, follow the rules. Is that okay? Play by the rules. So you wait. And what are you waiting for? Wait till price comes into your zone. And so the zone can be the tip of the thing. It is any point from this to this is the zone. It can be the tip, it can be middle, it can be, but once it's in the zone, it's in the zone. Is that okay? So there are 2 ways of trading this process.
So what if when it gets here and it decides to
When it gets where?
to the tip and then it decides to buy again?
Yeah, so that is it. So that's what I'm saying. There are 2 ways of trading. One is what you trade with a buy limit or a sell limit. So as you have done this, your analysis, you did this 7 a.m. in the morning. Let's say you're doing on the 1 hour time frame. And so you've marked these zones. So at 7 a.m., you notice that, okay, this is the zone 1.32448. Is the zone you are looking at getting involved in the market. So that 7 a.m., after you've done your analysis, then you go like buy limit 1.32448. Stop loss 1.31381. Take profit 1.34594. Period. You are done. Why? Your analysis told you this is the place you should be looking at entering the market. You are not entering the market just because this candle is green. So you go like, oh, I feel like it's going to buy, so it's green, I'm buying. No, you have a system. You have what? You want to buy at this supply and demand zone. At the demand, you see that, okay, price at a discount price. It's at a premium price. I can get it cheaper, buy low, sell high. Then again, if this is where the price is coming. So in that same day, as you have done it, you have what? Your buy limit here. You have your sell limit. Entry price 1.38981. Stop loss 1.400. Take profit, this. And then you are done. So that might take you what? 15 minutes of your day. And I have a 9 to 5 I'm doing. I don't have time to be coming to the chat every now and then. Like I'm an engineer, I'm working, I'm doing this. So put the trade down, trust the process. Hey, I'm risking 100 on this to make a 200. And then you're done. So at the end of the day, you know that, oh, that trade I took in the morning, if it goes in my favor, I win 200. If it goes against me, I lose 100 and I'm okay with that. Is that okay? And when you trade like this, it takes away the stress, it takes away the pressure, it takes away the panic attack, FOMO, fear of missing out, all these things. It dumps it down. How you getting it? So that is the process. So that's the first step. Trading with what? A limit order, a buy limit or a sell limit. And now, second step, let's say trader A trades with a buy limit also. Now, trader B is what? Is more conservative. Oh no, I can't just put in a buy limit and go. I'll not feel okay. Me 3 months with that. I'll prefer to see how the market is playing. That is okay. You decide, okay, I've been waiting 2 hours. Now price has come into the zone. Then what am I waiting for? You're waiting for the time buyers. This is the place you're looking for buyers. So you're waiting for the time buyers get involved in the market. And how do you know that buyers have gotten involved? You see that the green candle will be bigger, the red candle will be smaller. So when it happens like that, we call it engulfing. The green candle engulfs the red candle. So do you see it happen here? Yeah. You compare the green and the red, and what happens? The green engulfs the red. Then that tells me that EXNESS, buyers are ready. They are getting in the market. Yes, you waited for price to come to your zone, right? And now when price came to your zone, now buyers are actually stepping in the market. So now you can get involved, take the buy trade, put your stop loss below. Is that okay? And two different traders, but same process. Trading what? Supply and demand, waiting for price to come to what? Support or resistance, waiting for what? Price action. So this thing is what we call price action. You're waiting to see the action of the price, whether it's going to tell you to buy or sell. If it doesn't give you that engulfing, then the price action is not telling you to buy. Is that okay? So again, price action, you start seeing wicks. See the long lines, they are called wicks, or the shadows, or the leg of the candle. When you start seeing it, it is informing you that there's rejection. The market was trying to come down aggressively, but there are buyers that are staying at this low area, and they are preventing the market from going further down. Let's keep it here. We are going to take over. Like you've been reigning and ruling this market from this high to this drop. So we are taking over. And how do you know that? Yeah, the buyers are ready. Do you realize that when you compare this green candle and this red, the green is not able to engulf? It means it's not ready. Buyers tried stepping in the market, but they didn't have the momentum to overcome or overtake the sellers. Is that okay? So it's like you're having a fist fight. The one who's stronger pulls the person's arm. So you see that, okay, I see that when price entered the zone, buyers tried getting involved, right? But they are not ready. They've not been able to conquer the red. So I'm going to wait. Then again, it comes into the zone. Then buyers again come in. Do you see the green? Yes. But you compare, does this green engulf the red? No, because it's not bigger than the red. Are you getting it? Now this next candle is bigger, but you see that it takes two candles. It takes two to overtake one. Are you getting it? So it means what? Oh, that is telling me that still the sellers are strong. I need one big candle overtaking the red. Then I know that, oh, truly, like buyers are ready. Is that okay? So then again, inside the zone, then that is what you are simply waiting for. You see that now you compare this green with this red, still, it doesn't engulf it. It takes another candle too. So I'm like, still waiting. I'm waiting for that one candle that engulfs the red, obviously. Then price went up, made a move, came back to the zone. And then the last time you see what? Green overtaking the red. This is the only time you've seen what? Buyers overtaking sellers hands down. They have engulfed the sellers. So it gives you an extra confluence. Are you getting it? Price actions like, okay, now I'm able to interpret the chart I'm looking at. I'm not just seeing a bunch of red and green lines. I'm able to understand, okay, when it goes like this, when there's an engulfing, that means what? Buyers are gaining strength or they're gaining momentum over sellers. And so that is an extra edge for me to look for a trade. And so I'm going to I'm looking at getting involved in the market. After this engulfing, obviously this green is bigger than the red. So I'm going to what? Buy. And why am I buying? I waited for price to come into my demand zone. That is the place I'm looking at getting into a buy. And when price got into my demand zone, I didn't just take a trade randomly, but I waited for confirmation, waited to see if buyers truly are ready to get involved at this level, or am I the only one thinking of getting involved? So when this happened, then you know that, okay, then truly buyers are really trying to get involved in the market over here. Is that okay? So look at what, okay, as soon as this candle closes, then you are taking a buy. And when you take the buy, you are not God to say, chinchina automatically is going up. That is why you use a stop loss. This is my analysis. This is my speculation. This is my system. And based on my system, my rules have been met. So I can take a trade. Is that okay? And when I take a trade, then I will gently put in my stop loss and say that as I'm speculating market to buy, if market doesn't buy and it drops, in case it drops to this level, take me out. I'm only willing to lose 100 of my $1,000 account. I'm not willing to lose 500 and then I'll cry and I'll have heartache. No, I am risking a portion of my trade. Is that okay? So you go like, it is calculated. I'm like, hey, this is the trade I'm taking. If it goes in my favor, kudos to me. Give me my 200. If it goes against me, take out 100. Don't take out all my $1,000. Is that okay? Then, so let's say, so after you've waited, right? The process is what? So you realize that the third confluence is patience, waiting for price to come. You've done all the technicals, but another one is for the waiting, the discipline, the patience for price to come. And now you got a confirmation here, right? So as soon as this candle closes, the next candle, you're entering a buy. And this buy, you don't know for sure that it's going up. So you put your stop loss a little below what this swing low. And then you aim for what? Twice of whatever your stop loss is. This one is 2 points. Okay. Is that okay? So you take this trade and you can go about your stuff. Why? You followed a system. You followed a trading rule. Is that okay? So this is how you can call trades on your own, in your own space. Are you getting it? So now you can say, okay, set up my chart for pounds USD, set up my chart for euro USD, set up my chart for gold, set up my chart for NAS 100, US 30, whatever you decide.
US
Bitcoin.
is it the same as US 30 here?
Yes. So it depends on the broker. That's why we have the variables, like a symbol. Some will use M, some will use ECN, some will use like different. Are you getting it? So it depends on the broker. They just add that extra, but it's the same thing. And then you take that trade. So when you're trading this way, it's not complicated. It is systematic. It is rule-based. Is that okay? So what did you use? You use supply and demand. You use price action, and then use proper risk management. Going for what? A 1:2 or 1:3. I get so that trade could have also gone to 1:3. But it's all about the heart. When you're profit, do you want it to run forever or you take your profit? Are you getting it? So that is it. So what we've covered what? Support resistance, demand supply zone, right? Look at price action. Okay. So anytime you see these candles wicking out, you see the tails, the wicks, it's telling you that what it is moving momentum. If the wicks is to the downside, it's moving moment, it's losing momentum to the downside. If you're experiencing wick at the top side, it is losing momentum to the upside. Is that okay? So that is what wicks mean, or what wicks represent. And so you can also see that not all candles look the same. Some are small, some are big, some are medium. Are you getting it? So all of them have different names. The very big ones, we call it Marabozu, a big-bodied candle. It shows where the momentum is. Okay. So this big red, as soon as you see it, it tells you that the momentum is to the downside. See this big red momentum to the downside. Like obviously they are big. When you compare it with the majority, you see, oh, this is like distinctively it is big. It's a Marabozu. It could be a green big one. It is a Marabozu. Okay. Then you see someone, they are very small, and it has wicks. It has wicks at the down, wicks at the top. Some just have wick at the top. Some, are you getting it? So it gives it a name. So like this one, see that there's a wick to the downside, but we don't have wick to the upside. Then it looks like a hammer.
Yes.
Like literally a hammer. It has a head and it has a tail. Okay, this looks like a hammer. Then this one, it has what? A wick at the bottom, a wick at the top. It's a doji. Is that okay? So they have characteristics. I'll send you the image. I don't know if I've already sent it to you. Yeah, so I'll send it to you, the price action image. So you see, okay, a doji looks like this, a hammer looks like this, and engulfing looks like this. And all these will tell a particular story when you're trading. So when you see a doji candle, what that is saying is what there's about to, or there's a high probability for the market to have a reversal. When you see a hammer candle, there's a high probability for the market to have a reversal. And these are candles that have wicks. So that the wicks is bringing out the information that, hey, I was trying to go down, but I've been rejected. There's rejection. That's why I've wicked out. So this wick, in real time, these candles were not just a long wick like that. They were actually big red candles. Okay. They were big like this one. You see, at the end of this one closed big. But in this situation, it was big like that. But when it entered the zone, buyers rejected it. Like, hey, you can't come and do that momentum here. You can't come and have momentum and try and break lower. So this rejection tells you that, hey, buyers are wild at this area. They are looking at getting involved in the market at this area. They are not ready to let sellers take over. Is that okay? So there's a change of hands. So that the red or the sellers, the bears are becoming weaker, and then the bulls are becoming stronger. So anytime you see a wick in your zone, then that is telling you that what? See here. So this candle that you see it's red and it has wick. In real time, it was a big green candle. The market was going up. So it was a big green candle trying to go up. But sellers said, Master, this zone is a no-go zone. And so sellers resisted the market and pushed the market down. Is that okay? So they overcame. So when you see it like this, now you're able to interpret it. This candle, it means in real time, at the point it was a big green. But because this zone is an area of interest for sellers, they got in the market, actively resisted the green or the buyers, and then they took over this candle. So then you have that preconceived bias that, hey, I should be looking for what? Short opportunities or selling opportunities. So price action what? Tells you what to be looking for. So you hear traders say price action is king. It tells you, it tells a story. The action to take. Am I taking a buy or a sell? Is that okay? And one of the main confirmations for buy is when you have a bullish engulfing, meaning a green candle engulfs the red candle. And one of the main confirmations for a sell is when you have a bearish confirmation, meaning what? A red candle engulfs the green candle. So you can see over here, there's a green candle, there's a red, and this red has engulfed that green. So showing that what? We are coming down. You have it here. Are you getting it?
I'm getting it.
So it is bringing all these things together. You don't just come and sit behind and say, hey, today I feel pounds will buy. Today I feel pounds will sell. Then click buy or sell. No, you analyze the market. Use your technical tools you have been given. How do I interpret this market? It's not just a bunch of red and green lines. They have a meaning to it. They tell a story. How am I going to interpret this chart? And so your knowledge of what price action. Now you know that, oh, these candles, some are Marabozu, some are engulfing, some are these. And this is what they mean when you see them on your chart. Is that okay? Now we have zones. These are zones at which what market makes reversal. Market doesn't rise forever. Market doesn't drop forever. Is that okay? There's always a point of return or a point of correction or a point where the market pulls back. Is that okay? So Yes, I think.
I'd like to ask it. When you were starting, you said we have 4 time frames.
Yeah.
Do you need to select it here automatically?
So basically, right, during the 24-hour period, we have 4 different sessions. We have, or we can say 3. We have the London session, which covers Germany as well, the Frankfurt session. So that's like the European session, right? Then we have the New York session, okay, and then have the Asian session. So the first session, which is the London session, spanning from, if you are the Frankfurt, so you start from 7 a.m. But if you take out Frankfurt, you start at 8 a.m. So 8 a.m. to 5 p.m., that is what London sessions.
You don't select it on the trade view.
So you just
trading the London section, or it's just the time.
It's just the time.
Okay.
It's the time frame. So GMT, you say from 8 a.m. to 5 p.m. That is within what the London session. And from 1 p.m. till 9 p.m. That is what the New York session. And then from 10 p.m. to like 6 a.m. That is what the Asian session. So by the time you're able to know, okay, this is the time period. Is that okay? And so we are trading from 7 to 7. And that is what in the middle period we have an overlap of the London session and the New York session. Is that okay? And when the overlap happens, there's so much volatility. There's so much money. It's like, let's say only 1 million people were trading during the German session. Then at 7, 1 million people were trading. Then at 8, as soon as it turns to like 3 million, majority of people have come. Then at 1, it turns to like 10 million. Again, so there's so much activity. Majority of traders are online. I get it. Now, when it goes to the Asian session, New York, London, Frankfurt, they are sleeping. It's like Ghanaians, you are all sleep. So you see, majority of the continent are going to bed. And then Asia. So you have a few like Australia, New Zealand, Japan, China, just a few. So we don't have much volatility like we do when it's daytime. Is that okay? So by knowing the session, you know that, okay, I want to get involved in the market from 7 a.m. to 7 p.m. And then I'm done. Close my MacBook, come back the next day, repeat the same process. Are you getting it? So discipline, it takes like discipline to stick to your trading rules. Okay. So when you're trading, we've done the analogy on the daily. But let's say when we wake up, we want to do it on the 1 hour time frame. So I think on Pounds JPY, I was doing 1 hour. So let's go there. Okay, so Pounds JPY, there's the 1 hour time frame. So these blue lines, from this blue line to this blue line, it's a 24-hour period. So you have 24 candles. Is that okay? And then you see the time below. Let's go to the 15 minutes time. Let's go to 15 minutes. So you see what the time is, 6 in the morning, 12 noon, 6 in the evening. So by watching, you know that, okay, so from this period to this period, that is more like the London session. From this period to this period, London and New York intercession. Okay, so after this period, then it is New York. Then from 10 p.m. going or 12 midnight going is Asia. Are you getting it? So, and then we also have an indicator. It's called sessions. Sessions indicator. We'll show you the session. If you don't know the time, that from 7 to this time is London, and then it will show you that, okay, this period is, are you getting it? So I want to talk about structure. So when you look at the chart, right? What can you say? Is the market structure to the downside or to the upside?
To the downside.
Currently to the downside. Is that okay? You see that what? This is a high point. This is a high point. But when you compare this high is lower than this high. So we say what? It is a lower high. Although it's high, this one is higher high, lower high. Again, you compare this high and this high. This high is lower. So we say that this is a lower high. So it gives what? It's coming down. Now, when do we notice that the market has changed to an uptrend? when this high is broken, meaning price rises, and instead of creating a high below here, no, it goes ahead and creates a high here. Now you compare the highs, you realize that this new high is higher than this, then what the structure is changing to the upside. So by telling the higher highs and the lower highs, you're able to tell what the structure. Is that okay? So anytime the structure gets broken, you get to see it when you compare the highs of the market. So in the same way, when you're on the lower time frame, you're comparing it like that. Compare like that, and you're able to tell, okay, is the structure broken? Is the structure not broken? Is that okay? And then the structure, one way the structure is also formed is when you have a pullback and then a reaction, meaning that you see the market is to the downside. So obviously the market should be dropping. Like when the market was here, it had intended to come here, but it doesn't do that in one single red candle drop. It takes time. It goes up, comes down, as though it's not coming. See, it started from here. Price still came back to that zone, and it dropped. Price, I get so it's like it's going down, but it's like it's not going. That's all pass on. So when you see that, okay, market drop, then it rises again. Then there's another aggressive push. So that rising and that dropping creates a high. Is that okay? Then it drops, then it rise, and then an aggressive drop again. So that rising and dropping, it creates another high. Again, again, again. Then it does that. Is that okay? So anytime you are trading, you can be looking at the structure to tell the trend if the market is in a downtrend or it's in an uptrend. Is that okay? So in another market, if the market was not doing lower highs, but I was doing higher highs, the high kept getting higher than the previous. They say that it's in an uptrend. So okay. So when you see the structure, you know that okay, this market is to the downside. So when a sell setup is ready, it is an easily take for you. Is that okay? It's an easy go for you, like, oh, I can take this trade easily. When you see that the market is in an uptrend, and then you get a buy setup, I can easily take this trade. Is that okay? So any question?